Okay, so now let's continue doing what we doing the basically the exact same setup, the same example, but now instead of considering things through graphically, let's just consider the same example when home specializes. Well, has is relatively abundant in terms of capital, and the computer industry is capital intensive, and home we're going to think is going to open up to trade. And let's consider that case numerically. And what I'm going to show is that when we consider things through algebraically and numerically, the same results are going to hold up. And so the setup is going to be the same. We're going to have computers and shoes with the following production functions. And just to make everything consistent with what you've seen in lecture, I'm just going to write these as YS and YC. Okay. And so let's consider question 1, where it's going to ask us to derive the relative labor demand curves as a function of the wage to rent ratio. And so recall that in class you saw a way to derive these relative labor demand curves as a function of the wage to rent ratio. What I'm going to do in this section today is I'm going to do something a little bit different. But hopefully I find my method a little bit easier, a little bit quicker, because you don't have to take any derivatives. But if this method doesn't make as much sense to you, that's totally fine. In section 7 section notes, which I posted, I go through both this method and the method shown in class. So you can do whatever makes more sense to you. The other method is going to involve taking basically the marginal products of labor and capital in each industry. In this, I'm going to rely, in this method, what I'm going to do to answer this question is I'm going to rely on properties of Cobb-Douglas functions, similar to how we saw in section 1, part 4, some of the properties of Cobb-Douglas utility functions. And so if you haven't seen that, I really encourage you to go back to section 1, part 4 and review that. It's reviewing that is really going to save you a lot of math, and I think using properties of Cobb-Douglas functions is really going to help you. So just to sort of quickly recall what the upshot was of that section, in section 1, part 4, what we said was if we have a utility function that's defined over the consumption of two goods, and sorry, let me erase these y's that are just floating around. What we said in section 1, part 4 is suppose that we have a utility function that's defined over the consumption of two goods, good 1 and good 2. And suppose, just for simplicity, that our utility function is equal to q1 raised to the half and q2 raised to the half. So it's just q1 squared times q2 squared. Well, then the properties of Cobb-Douglas utility functions imply that we're going to spend half of our income on expenditures of good 1. So this is our income, so we're spend half on our income, and this is expenditures of good 1. And likewise, that we're going to spend the other half, the remaining half, of our expenditures on good 2. And these exponents here, these shares here are just directly coming from these exponents. And so if this exponent was different, so would the share of income that was being spent on the good. So that's just a quick rehash of what we did in section 1, part 4. But we can look at production functions, and as long as they're of the same Cobb-Douglas form, then what we can think of is similar to a consumer has income, then firms have revenues. And so if I call a firm's revenues II, so this is going to be revenues. Well, notice that here we have that firms are going to be making 0 profits. There's total perfect competition. And so whatever a firm's revenues are is exactly what its expenditures are going to be on hiring the factors used in the production of this good. And so in particular, production of my good is only going to be using labor and capital. And so the amount of money that I use to pay both laborers and factors of capital or owners of capital is going to be exactly equal to what I'm bringing in revenues. And so if I think about the amount that I'm spending on hiring workers, that's going to be W times LI for industry for industry I, then which is also called the wage bill. Then from the properties of Cobb-Douglas production functions, I'm going to look at this exponent and I'm going to say, well, given that the exponent on labor is 1 minus alpha, then whatever my expenditures are, I'm going to spend 1 minus alpha of those expenditures on hiring labor. Likewise, the remainder has to be spent on hiring capital. And so if I'm spending R times KI on hiring capital, that's just because R is basically the price of capital and KI is the number of units of capital I'm hiring. Well, then I have to then I'm going to spend a share alpha I of my revenues on hiring capital, and so these two are going to add up to my total expenditures. Okay, and so in this way, I can figure out how much my expenditures are going to be on both labor and capital as a share of my revenues that I have coming in. And so the slides just say exactly what I just wrote down. Okay, so so let's go back and use this to figure out what the amount of LC, the amount of labor and capital are going to be hired by both the computer industry and the shoe industry. So going back to this example, I'm going to want to figure out what alpha I is for each sector. So for instance, let's figure out what alpha KC and alpha C and alpha SR for each sector. So all I'm going to need to do is for each sector, I'm just going to need to read off what their exponent is going to be on capital, and that will tell me what alpha C and alpha S is. So so I'm just looking at this exponent on capital, and so for the computer industry, that's 2/3. For the shoe industry, that's 1/3. So so that's how I can figure out what that alpha is. Okay, so now if I have that W times Li is equal to 1 minus alpha I times II, which is just, recall this is expenditures of sector I, well, all I'm going to do is to figure out what LC is, I'm just going to look at C, and so W times LC is going to be equal to 1 minus alpha C times IC. Oh, oopsies. Sorry, this here is not an equals, it should just be a times. Okay, so if I just divide on both sides by W, what does this give me? This gives me that that LC is equal to 1 minus alpha C times IC over W. And now all I'm going to do is I'm just going to plug in for alpha C. That's going to be 2/3. So this gives me 1 minus 2 over 3 times IC over W. So that's just going to give me that it's 1/3 IC over W, which is exactly what this is. I can do the same for the rest, but I think you sort of get the idea. And the upshot is that we get that LC, KC, and LS over KS are given by those. So one thing that we don't know yet is we don't know IC and we don't know IS. But remember that all we're trying to do is we're trying to get LS and KS as a function over W over R. So you can see that if we just take the ratio of LS over KS, these IS's are canceled, which recall that we don't really know, and then all we're left with is some function of W over R. So let's do that. So LS over KS is going to be given by, well, this is 2/3 over 1/3, and then we are left with IS over W, over IS over R. Okay, so what is this going to be? And I'll try not to keep tilting my mouse. Sorry about that. So this 3 is going to flip up and cancel with this 3, so I'm going to be left with 2. These IS's are going to cancel, and this R is going to flip up, and so what I'll get is 2 R over W, which alternatively, I'm just going to write as 2 R over W to the negative 1. And sometimes that will be useful, sometimes it won't be quite as useful. To find out what LC over KC is going to be, I'm just going to take these two expressions. So that's going to give me 1/3 all over 2/3 times IC over W all over IC over R. So what's that going to give me? Well, these 3's are going to cancel, and I'll be left with 1/2. These IC's are going to cancel, and I'll just be left with R over W. And so if I want to flip upside down the R over W, then this LC over KC is going to be equal to 1/2 R over W inverse. Okay, and that's just shown right here. And I've noted that you can also look at section 7 solutions or the lecture slides to see an alternative way to solve this. Okay, so in question 2, part 2, just like we showed graphically how the wage to rental rate of capital ratio is going to be determined by the equilibrium condition for relative labor supply and demand, we can determine that numerically. So right here, all I'm going to do is I'm going to go back to my expression for relative labor supply. That's going to be the left-hand term. And relative labor demand, that's going to be the right-hand side. And I'm just going to recall what LC over KC was from before. And then all I'm going to do is I'm just going to plug in here for LC over KC and LS over KS. So what's that going to give us? It's going to give us L bar over K bar is equal to 1/2 R over W times KC over K bar plus 2 R over W times KS over K bar. What I can do here is I can just pull out both R over W's from this expression, and then I'll just be left with some function of the K's in there. All I'm going to do here is I'm going to just cross multiply by W over R, so these are going to cancel. I'll be left with W over R here, and then I'm going to cross multiply by K over L here, so these are going to cancel, and then I'll just be left with K over L here. Okay, and then that gives me the bottom expression. The next thing I can note here is that there's a K bar and a K bar there, so I can just cancel them out and then move this L bar inside. And so this tells me that the wage to rent ratio, W over R, is going to be given by 1/2 KC plus 2 KS all over L bar. And so in part 3, what we're going to be asked is we're going to be asked how this this ratio W over R is going to change as home opens up to trade. So recall that in question 1, part 2, we said that KC is going to increase and KS is going to decrease. Technically, what we said is we said that KC over K bar is going to increase and KS over K bar would decrease, but that's the same as saying that KC will increase and KS will decrease. So you can notice that if KC increases and KS decreases, well, this 2 on KS is smaller than this 1/2 on KC. And so for instance, you can notice, suppose you can plug in for values and confirm this, but suppose that KC initially was 2 and KS was 2 as well. Well, then what's this going to be? You can just plug this in, and so if KC is 2, this is going to be 1 plus 4 over L bar, so this is going to be 5 over L bar. Well, now suppose that KC goes up to 3, and KS, well, we have to have a 1-for-1 trade-off, so KS is now 2. Well, notice that this expression above is now going to be 3/2 plus 2 over L bar, and so then I'm just going to rewrite this. So this is going to be this is going to be 3 halves plus 4 halves over L bar. And so that's going to give me 7 halves over L bar. But 5, if we just want to rewrite that, that's going to be equivalent to 10 over 2 over L bar. And so this is going to be smaller. And so you can notice that because we have a 1-for-1 decrease whenever one unit of capital moves from the shoe industry into the computer industry, we have that there's a smaller smaller coefficient in front of KC. We have that W over R is going down. So it's smaller than now what it was before. Okay. And so this is the same. Because we've had our relative labor demand curve shift more towards the computer industry, we've had that relative demand for labor on aggregate has gone down, and therefore the relative wage of laborers has decreased as well. So question 2, part 4, and this is the confusing part from last time, but I think it's a little bit easier to see numerically is what's going to happen to the labor intensity or relative labor demands of both the computer and shoe industries. And recall that the labor intensity is just the saying LC over KC or LS over KS in the case of the computer and shoe industries respectively. So recall that I had that LC over KC is equal to half times W over R, and LS over KS is equal to 2 times W over R. So because W over R is decreasing, and W over R is over -1, this means that LC over KC is going to increase. Likewise, if W over R is decreasing, this -1 means that that will be flipped upside down, and so we'll have that both LC over KC and LS over KS are increasing. And so the labor intensity in both industries is going to increase because labor is now relatively cheap. And let's move on to question 2, part 5. So question 2, part 5 says, after home opens the trade, what's going to happen to the marginal product of capital in the computer and shoe industries, and what's going to happen to the marginal product of labor in the computer and shoe industries? And so I didn't figure out what the marginal product of labor and capital were before, but basically from lecture, suppose that I want to figure out the marginal product of capital in the shoe industry. Well, what I'm going to need to do is I'm going to need to take the partial derivative of the production function for shoes with respect to capital employed in the shoe industry. Okay, and so what's that going to be? Well, essentially what I'm going to do is I'm going to pull down this exponent 1/3 here and multiply everything out in front, and then I'm going to subtract 1 off the exponent here. That's how you would do this partial derivative in this case. And so MPKS is going to be equal to 1/3 times AS times KS to the -2/3 times LS to the 2/3. And then you can notice that this exponent, this negative exponent means that we can just rewrite this as 1/3 AS times LS over KS, all raised to the 2/3. So that's how you would figure out what MPK and MPL are. I'm just going to do it for MPKS and then show you what the remaining look like. So the marginal products of labor and capital, so this should say labor and capital in both industries are as follows. So like before, I said that we have the MPKS is equal to 1/3 AS times LS over KS to the 2/3. And you can do the same, just take to figure out the marginal product of labor in the computer industry, for instance, just take the derivative of YC with respect to LC. And so hopefully you see how to get all of these. If not, just send me an email and I can walk you through it. Or show up to office hours. Okay, and so notice that we said from before that LC over KC is going to increase, and LS over KS is going to increase, and that's because labor is now relatively cheaper in both industries. So if LS over KS is increasing, this means that MPKS is going to increase because this is a positive coefficient, so this means that MPKS is going to increase with LS over KS. Likewise, MPKC is going to increase as well, too, for the same reason. However, because now LC over KC is flipped compared to what it was before, this means that if LC over KC is increasing, MPL is going to decrease, and likewise, MPLS is going to decrease as well. And so that's saying what I just said there. And so the reason you can think of that is that we have relatively more labor working per unit of capital in each sector, and so you can think that now capital is working. We have relatively more. We have relatively more labor for each unit of output. And so each laborer is going to be less productive, whereas now capital has more labor to work with, and so each unit of capital is going to be more productive. And so this is just going to be diminishing marginal returns to each factor that are just kicking in here. When you're a factor that has a lot of the other factor to work with, you're going to be relatively productive. If you're a factor that doesn't have a lot of the other factor to work with, you're going to be relatively less productive. So that's what this is reflecting. So now we're going to think, and this is going to relate to the Stoper-Samuelson theorem. We're going to think of what's going to happen to the real return of capital. In other words, what's going to happen to the wage of capitalists in terms of the numbers of computers and shoes that they can buy. And so the one thing that's worth noting is we can note that if we have production in a given sector, say computers, then we know that we're going to hire capital in the computer industry. And so if we're hiring a factor of production in a given industry, we know that each factor must be paid its marginal revenue product. That's coming from the assumption that we assume that there's perfect competition, both the output and the goods markets in these models. And so that means that, for instance, capital must be paid its marginal revenue product. And so that's going to be the marginal revenue product is equal to the product of the marginal product of that factor in that industry. That's going to be MPKC in this instance, times just the price of that output. Okay, and so this is going to be, in other words, the marginal revenue product of capital in the computer industry. Okay. Likewise, if we have the capital is being employed in the shoe industry, it also must be paid its marginal revenue product in that industry, which is just equal to MPKS times PS. All this is to say is that if we divide by PC on both sides of this equation, what we'll get that RC over PC is equal to MPKC, and RS over PS is equal to MPKS. So if we want to think about the real return of capital, in other words, if I'm a capital owner and I spend all of my income on either computers or shoes, what's the total number of computers and shoes that my income can buy? And so then all I have to think about is what MPKC and what MPKS are. And it's important to note that likewise, we have, as we've seen before in previous models, we have free factor mobility. And so if we have output in both sectors, we have that R is equal to RC, which is also equal to RS. And so note that if you're sort of confused that, it could be that capitalists are paid a different wage in both the shoe industry and the computer industry. Note that if there's production in both, that means they're hiring in both, and so both industries must be paying capital exactly the same, or else capital would choose to flee and only work in one industry, the industry in which it'd be paying a higher wage. So the real return of capital can just be written as the marginal products of capital in each sector. So recall that we said that the marginal product of capital now is working with relatively more units of labor. And so capital in both sectors, because the labor intensity in both sectors is increasing, the marginal product of capital in both those sectors is increasing. And so this implies that MPKC and MPKS are higher than what they were before. And so now capitalists can buy more in terms of both computers and in shoes. And so what does that mean? That means that regardless of whether or not capitalists consume computers or shoes solely, or some combination of the two, they can consume absolutely more of any combination of both computers and shoes. And so they're going to be definitely better off now because they can buy both more computers and shoes with their income. What's going to happen to the real return of labor? Well, similarly to the return of capital, we have that in each sector, that we have output being produced. Workers are going to get paid their marginal revenue product of labor, and so that means that W is going to be equal to MPLC times PC, and W is also going to be equal to PS times MPLS. And so the real return to labor, or the wage of workers in terms of the number of computers and shoes that they can buy if they spend only on those two goods, is just going to be given by the marginal product of labor in each sector. However, since we have that there's relatively more workers in both computers and shoes now, when we open to trade, we have the marginal product of labor has decreased. And so now workers, the income of workers expressed in terms of the number of both computers and shoes they can buy has decreased. So if we ask sort of a politically, trenchant question, or sort of a politically sort of salient question of whether or not, when you have both capital owners and laborers who are living in a democracy in which they can vote to decide whether or not homes should open up to trade, we can think of whether or not, if either workers or capitalists are voting in their best interest, how they're going to vote. And so capitalists, as we've seen, can benefit from trade in that they can now buy either more in terms of the total number of computers or shoes. And so regardless of whether or not they like computers or shoes, they can buy more. And so capitalists have unambiguously benefited from trade. So capitalists would vote in favor of trade. Likewise, workers have lost because workers can now purchase less of both computers and shoes, and therefore less of the combination of the two. And so workers unambiguously have lost here. And so workers would decide that when they opened a trade, they would lose. And so they would rationally think that if you could vote on whether or not you were going to open to trade before you actually do open to it, they would vote against it. And so this is, hopefully with this numerical example, we've demonstrated to you some of the results of the Stokes-Samuelson theorem. And so recall that the Stokes-Samuelson theorem is saying that a rise in the relative price of a good will lead to a rise in the real return to the factor, which is used most intensely in the production of a good. And conversely, a fall to the real return to the other factor. So when home opens up to trade, it has a rise in the relative price of computers, and therefore capitalists who are the owner of the factor that is used intensively in the production of computers have benefited, and likewise laborers whose factor of production is not used intensively in the production of the goods whose price is increased have unambiguously lost. And so this sort of sets up an interesting takeaway that that now, depending on whether or not in your country you're the owners of a factor that's abundant in your country, you may either lose or gain from trade. And so it suggests that depending on which factor of production you're going to own, you may either unambiguously gain from trade or unambiguously lose. And so it suggests that in sort of a political economy sense, there's going to be different members of society who are more or less agreeable to international trade. So anyway, I hope that's been interesting. I hope you'll take away some of the political sort of be sort of interested in some of the political takeaways from this. And so I will see you all in 2 weeks, and thanks so much for tuning in. Take care.